Budweiser, the world's biggest beer company, has been in a lot of hot water recently. To present itself as more inclusive, Bud Light sent trans person influencer Dylan Mulvaney a handful of beers. In turn, Mulvaney created a video and images featuring the beer. A PR crisis ensued as the storied beer company waded into a political firestorm. The company backtracked after plenty of people made their displeasure known, yet you wouldn't know it by looking at the company's share price. Even the most vocal detractors have little influence when you have a good product. Now, as investors, all we care about is the business performance and the outlook. And that's true of financial pros who search for Bud's parent, AB InBev, a stock that we rate at 5 out of 10 at a record clip according to Trackstar, our proprietary sentiment indicator. AB InBev has bigger problems than one bad campaign. Since its formation, it's become one of the world's largest beverage companies, growing to encompass over 500 brands across cider, lemonade, energy drinks, and beer such as Budweiser, Michelob, and Stella Artois. With operations in almost every continent, it's focused on a multi-pronged strategy of innovating and reinforcing core brands, whilst expanding premium brands, non-beer and non-alcoholic beverages. Growth isn't easy for a company of InBev's size, and that coupled with decreasing margins has seen the shares of AB InBev fall steadily from their 2016 peak. Forecasts don't paint a pretty picture, with price to cash flow worsening next year. The company also has huge debts that cost billions of dollars a year in interest payments. Molson Coors trades at a cheaper valuation in every category, but when it comes to profitability, AB InBev boasts the best margins and the best returns across most categories. Consumer defensive names are expensive, whether it's Bud or Coca-Cola. We're not a fan of overpaying for security though. If Bud revisits its 2022 lows around $40, that might make it interesting. But with lackluster growth and no real plans to stimulate sales, we'd rather shop elsewhere.